very much, Tamara. Good morning, everybody. Good afternoon, depending on what side of the ocean you're on. It's a pleasure to be here. We have a hopefully very exciting forum to talk about the future of what's going on in fintech. It's been quite a disruptive year this year. And what I'd like to do is start by introducing our panelists and ask them each to say just a little bit about themselves. Jeremy Takle, perhaps we start with you.
Hi, my name is Jeremy Takle. I am currently the CEO and co-founder of a new startup bank in the UK, Pennyworth. Before that, I was a 24-year executive at Barclays.
Thanks, Jeremy. Charlotte.
Hi there, my name's Charlotte Crosswell. I'm Chief Executive of Innovate Finance, which is the UK's fintech industry body.
Thanks, Charlotte. Susan.
Hey, hello everyone. I'm Susan Chapman-Hughes, and I lead digital data and ops for the commercial business at American Express. It's great to be here.
And finally, our second Jeremy.
Hi everyone, I'm Jeremy Balkin. I'm head of innovation and strategic digital partnerships for Hsbc and a proud Australian accent.
Excellent. Thanks, Jeremy. Quick overview of what we're going to do over the course of the next 45 minutes. We'll have a short discussion at the start with a few questions that I'll tee up to get the conversation going. Would very much appreciate if attendees and participants ask any questions you've got by using the Q&A chat function or the Q&A function that's in the lower right-hand corner of your screens. Please ask questions. We've got quite an illustrious group of folks here who I think can give us a great perspective on what the future is going to look like. To kick off, it has been quite a disruptive year. I think we've all, across our organizations, already been on quite a move towards a kind of digital within financial services. But with COVID hitting us, I think all organizations have seen significant disruption and a significant speed up as to what they're doing. First question I put out to everybody is, what are the big themes you think the financial services industry is going to experience, and how's it likely to evolve over the next couple of years? And maybe I'll start with Jeremy Takle.
Yeah, thanks, Steve. It's important, I think, to recognize that we're obviously very focused on the sort of short-term impact of COVID, but I think the longer-term big rocks that are out there for financial services are particularly influenced by what I would characterize broadly as open finance. I think the ability to go beyond just the institutional limit of where you hold your accounts or how you construct your banking is going to be the biggest change for banks going forward. It essentially limits the traditional constraints to switching that the incumbents have had, and opens up an ability to configure and create new products.
Sounds great. Charlotte, you also represent a number of kind of new fintechs and startups, as Jeremy does, coming from Pennyworth. What's your views on this one and the key trends going forward?
Yes, and some of those fintechs are not so new anymore. So there are 8 fintech unicorns in the UK, and as you've heard from Hussein, it's a sector that continues to grow and get a huge amount of support from UK government and industry. Certainly, the crisis is accelerating digital transformation in financial services. There's not a CEO of a bank that I'm talking to or an asset manager who's not putting this at the top of their list. And it might have been tempting during the crisis to think, we'll cope with the crisis, then we'll worry about innovation and strategy. But that's just not the case. It's accelerating all the time. Asset management industry is saying that potentially it's accelerated by 3 to 5 years in terms of their plans. So just an incredible opportunity for fintechs to show what they can do and respond to this. And obviously they're much more nimble. They've got the opportunity to show the way. But also we're seeing those big financial services incumbents coming through and embracing change. I think it's something we'd already seen in the UK anyway, and obviously the US is the same, but other parts of the world were slightly resisting that change, maybe looking to the fintech sector with a little bit more suspicion. And now the opportunity is for driving forward those partnerships for the fintechs to to grow and really take their businesses to the next level, and just going to be an incredibly exciting 2021 as some of those plans get realized.
Thanks, Charlotte. You made reference to a number of the incumbents. Unfortunately, we've got representatives from 2 incumbents on the phone here as well today. Susan, would love to get your thoughts from the perspective of American Express.
Yeah, I mean, listen, I agree with Charlotte that the digital transformation acceleration efforts are definitely in order. I think, things that have been on the shelf that people have thought about doing certainly have leveraged this opportunity to move forward on those. One of the things is thinking about this kind of unified membership experience for customers and how do you actually engage with them, bringing together an experience that they're very much used to in other parts of their life. And so, companies like ours are looking to, leverage operational resilience and transformation efforts to certainly move those things forward. I think it's been interesting because, you've had this whole piece where we've had to move entire groups of people home, right? So literally all of our employees are working from home right now. So moving that forward has not been the easiest thing, but I would also say that it has certainly sped up decision-making and focus. And I like to use this term of ruthless prioritization. And I know from talking to peers in other parts of, other companies, they are doing the exact same thing. And I think you're going to continue to see larger companies that have been around for a while, financial institutions, leverage that momentum going forward. I don't know that anyone wants to go back to the old way of doing things. And so, really doubling down on efforts for operational improvements and resilience, I think we will continue to see happening.
Thanks, Susan. Jeremy Balkin, why don't we conclude this question with you? Key trends, key things you see coming down.
Thanks, Steve. I think transformation isn't a 100-meter sprint. It's an ultra marathon that just never ends. There's never a finish line. And I think if there's one thing that I've observed from our clients and consumer behaviors over the past 10 months during this pandemic, it's that whereas historically you've seen sort of B to B to C influences, I think it's the opposite. It's going C to B to B in terms of changes. You look at customer behaviors, look at digital adoption across every sector, no less financial services. You look at e-commerce having over 100% growth in the first 3 months of the pandemic. You look at entire industries that are going to change as a result of consumer behaviors to adapt through resilience. You look at payment profiles that are going to change, technologies, and of course, from a bank's perspective or a large financial institution, we have in some ways the benefit of incumbency. It's hard to disrupt the billions that we've spent building the moat and the barriers to entry. At the same time, the technology is sped up to such an extent that then you have the sort of the negative economies of scale, which is you have to continuously innovate and upgrade those systems to compete with new entrants or your competitors. So again, I think that's a good thing. It benefits customers. At the end of the day, we all share the same customers, whether we're a bank or a fintech or a potential new entrant. I think that's a good thing. And we're seeing also, I think what's interesting in this instance is you're seeing actually a convergence of digital adoption across countries and regions, whereas before maybe some countries or regions were lagging others. You're actually seeing a leveling of the digital playing field. And I think that's actually a good thing going forward for the society we want to live in and for financial services.
Thanks, Jeremy. I loved how you framed the notion of C to B to B. And you talked a little bit about the changing customer and consumer expectations. What are the biggest changes you've all seen in those changing consumer expectations over the course of the last 9 months? Jeremy,
Steve?
Takle, maybe you want to take the lead on
Yeah,
that?
no, happy to. Yeah, I mean, we've absolutely seen an acceleration of digital adoption. That's pretty much self-evident in the sense that people have just been required to do so. What we've definitely also seen is a change in the demographic of people that have been willing to take up digital tools, whether that's in finance or in ordering food, etc. So I think that's always been a case. It's been accelerated during this period, which is one of the I think one of the most interesting things about the environment as a whole, which is now you've had this moment where digital adoption has been accelerated for individual consumers, And at the same time, we had for some time had this expansion of technology that enables you to build businesses that cater to changing patterns, and that technology has become democratized. It's very easy, from setting up a delivery service for your restaurant through to today being able to curate a banking service as a software as a service. It's become democratized. So this coming together of these two patterns, both in terms of technology being democratized and changing behavior, I think is a special window that we've suddenly entered into. It was coming for some while, but at least from my perspective of setting up a bank, this is something that I've not been able to contemplate in my career as a banker for most of that 20 years I spent in banking. Banking was a scale business. It required that you had big distribution channels. It required that you had big technology. And now the changing that consumer behavior, people willing to bank directly, and the change in the availability of the underlying assets has completely changed the structure of the market, and has only been accelerated by COVID.
Yeah, I mean, look, the leading indicators are always about like people's personal experience and what's happening for them. And so you have large swaths of people who could not go to the grocery store, couldn't go to restaurants, couldn't go to places. So it became a procurement game for them, driven by technology, right? Digital technology. And so that experience of being able to order your groceries and have them delivered to your house has changed their behavior around what they're willing to accept from a digital adoption perspective for anything. And that certainly goes to be said for financial services. And so I think, look, we've seen customers' expectations rise. For us, they want simple, they want easy. They don't want to have a lot of complication in the way that they engage with us. They want to be able to transact. They want to be able to get their loans. They want to be able to do different things. And depending on who you are, whether you are a small business where you're trying to survive. I mean, we've had many small businesses who have had to literally shift their entire business model of what they do and how they sell to something completely different, given what's happened with the pandemic. And now many of those have opened up opportunities for them to keep those things going forward and to build their business off of that, all the way through our large enterprise customers who now have a different problem to solve, right? Because their employees are not traveling. They're not going out. They're really trying to figure out how to manage and leverage their supply chain. And so I think the rules of like real having, simple, easy solutions that really drive productivity for those businesses are things that we're going to continue to see pushing forward, and customers are going to be asking for that. But again, you think about your personal life and what have you expected over these times, and you take that into the office, you want that from the same of your providers, especially your fintech providers.
It's interesting when you just look at the changing demographic of digital users. Sorry.
Go ahead, Charlotte.
Okay. Yeah, it's interesting when you talk about the changing face of who's consuming digitally as well. It's estimated 12% of the adult population in the UK downloaded a banking app for the first time during the crisis. And guess what? That tends to be the elderly population who are very used to going into a bank to pay their bills and suddenly had no choice. So I think when we look at that minimum customer service, people used to want to pick up a phone, really hard. Right? It's really hard trying to get hold of a call center in those first few weeks of a crisis, as every bank had to sit there and take those remote. And so they did. They moved to digital, and they want a really simple digital experience. The same with the government loans that certainly in the UK we went through. The first few weeks was just pretty well through the main banks that had been licensed in the 2008 crisis. Well, guess what? Everyone had a different bank relationship nowadays. So all of those lenders had to then go and get accredited to distribute those loans, and those SMEs, were calling for that because they wanted to get the loans from their current bank relationship. So we're seeing that shift coming in from the consumers, from the small businesses, and that's not going to go back. I don't think we're going to go back and find that people suddenly walk down a bank and sit in line and wait to be served anymore. So it's going to be for everybody to just keep going on the simplicity, but add to it and add to it and add to it to make that a really great customer experience.
Jeremy Balkin.
Thanks, Dave. I think Susan made a great point about people relate to their own personal experiences. And, when I grew up as a kid in Australia, I remember sort of believing the old adage that it takes 21 days to form a habit. Of course, when I did some study on it in the course of just observing consumer behaviors in my day job at Hsbc, I found that some of the most comprehensive research on this was published in the European Journal of Social Psychology that found that it takes on average 66 days to form a new habit. So let's say 10 weeks. I'm based here in New York. I've been living at work, or is it working remotely, since the 10th day of March. I've gone through that 66-day cycle almost 4 times, as have millions of our customers. So you think through, what new habits have they formed? Well, we know that e-commerce as a percentage of all commerce pre-pandemic was 16%. E-commerce has probably got a 20 to 25 year history. Within 3 months of the lockdowns, e-commerce had grown from 16% of all commerce to 33% of all commerce. And I haven't seen the latest data, but I suspect that between Thanksgiving, Black Friday, Cyber Monday next week, it's a lot higher than 33%. And I would dare say that it ain't going back down to 16%. You're seeing digital adoption trends that have gone almost a decade ahead. You think through, even, there's a lot of talk about millennials, but what about Generation Z? The 2.5 billion who are coming of age now. There's some interesting data that came out this week about their preferences for payments, for example. Number one preference to paying is cash. Number 2 is their phone, and number 3 is debit. They don't have a concept of a credit card there. So you think through, what does that mean for the traditional incumbent credit card payment processing industries and interchange fees and all the businesses that are on that supply chain? What's that going to mean for the changing nature of payments going forward, any more than, as I said before, the C to B to B piece, and how that's going to shift entire wholesale PCM businesses, and in some ways the barriers, the competitive advantage that legacy and incumbent financial institutions have had the advantage of for so long. So these are not insignificant structural shifts to consider. In fact, quite the opposite. And I think part of why this is such an important forum is to get experts together and learn from each other, and frankly share best and worst practices so that we can navigate this together. Because if there's one thing that 2020 has proven to me, is that we all rise and fall together. And let's hope we all rise together next year.
Couldn't agree more with that one. We've had some action happening in the Q&A forum, and I want to ask a question here from Dan Fahini, if I pronounced his name correctly. Started by saying, historically, fintechs have had more of a reputation for being very fast, very agile, and larger incumbent institutions have had a reputation for being a little bit slower and more cautious. Everybody's had to speed up over the course of the last 10 months. What are the best ways, and any great examples around how more nimble fintechs might be partnering with larger incumbent banks? Are the great stories? And what are in particular, I might start with Jeremy and Susan on this one. What are you doing to enable yourselves to partner more effectively with some of the smaller, faster moving companies?
I'm happy to go first. So listen, what's interesting is I think there's always a misnomer. I just want to say for the record that just because you're a large institution doesn't mean you can't move fast, right? So I think there's like this belief in the world that like fintechs are fast, established financial institutions are not, and I don't believe that's the case. I think actually what's interesting is when you look at what fintechs typically do, they find a narrow lane to disrupt, right? And that's what allows them to draw customers, but it doesn't come without issues, right? So you look at what's happened over the last 6 to 8 months with COVID coming in, many of those fintechs that were moving fast and raising lots of money have run into roadblocks, right? So their financial situation has certainly changed. Their customer base has certainly changed, and that has impacted their businesses. So the amount of flexibility that they can bring to the table to be able to weather the storm, if you will, has not always been easy. But what that has done is I think it has accelerated the desire for larger financial institutions like ours to actually work more closely with those fintechs. I mean, I don't know of a large financial established institution that doesn't have a ventures arm that for the last several years has been out investing in emerging technologies that we believe that can actually help us. And so, our ventures team is very active. They've been in the marketplace for quite a while. And just most recently, we acquired Cabbage, And so I think you're going to see more of that activity, which I think is a good thing. I don't think it's either or. I think it's both and. And, you know, I think, look, it's good because, you know, when we see the disruption, it forces us to be on our game, to up our game. But I also would say, you know, look, we've got stickiness with our customers. We've got large established bases with our customers. We also have a tremendous amount of data that allows us to do different things that fintechs can't do. We, you know, for companies like American Express, we have a long history of very, you know, stellar customer service. Like those are all accretive and really great things that actually help us compete in the marketplace. But I think you're going to see more partnerships, you know, enabled by technology. And I think you're going to see more opportunities for, you know, larger financial institutions to continue working with fintechs. I actually think it's a good thing for the ecosystem because I think, and if you go to different places around the globe, you see where, you know, some of these smaller fintechs have solved really critical problems for real things that people, you know, real issues that people have. You go to Africa, I mean, quite a bit of the financial institution systems across many of the countries in Africa have been driven by fintech activity, which is wonderful because it's helping people eat, it's helping people, you know, save, it's helping them build their businesses. And so I think those are all great things and opportunities for companies like ours. Jeremy, I don't know how you feel about it.
Well, Susan and I are kindred spirits, as we know, and I couldn't agree with her more. I would simply also add that, you know, you're actually seeing a convergence in speed. So banks are getting quicker and fintechs are getting slower because whether they're hitting roadblocks or they're just realizing that to be legitimately credible in a highly regulated industry, that they might need an extra field or an extra screen or an extra set of questions for KYC, you know, AML, financial crime compliance reasons. You know, they've got to maybe slow down a little bit because that's, you know, if you want to play in the space and be taken seriously, especially in a highly regulated, importantly regulated industry, they've got to do that. At the same time, the competition for banks is very important. Banks have been too slow for too long, and hiding behind incumbency and complacency and lack of competition is not acceptable in my view. And I think that's one of the most positive impacts. I mean, I've been in this role for over 5 years now. When I joined, one of the first deals we did, which was actually, I think, the first legitimate fintech partnership in HSBC's history, with a company out of Chicago called Avant to build a mobile personal lending platform. To give you an example, it took 87 days to sign an NDA, which I was told on the bank side, that was actually a record. The fintech couldn't understand why it didn't take 87 minutes or 87 hours. And of course, it took 18 months to negotiate an MSA and then literally 4 months to actually do the tech build. So to give you a sense, over, let's say, a 2-year period, the tech piece, which you think would be the hardest, took the least amount of time. Point being is that was the first one. It was the hardest one. We've probably done a dozen since in my team alone. And they're getting faster every time because the bank's getting better muscle memory. If the bank's moving faster, it realizes we can't slow down because customers expect it. And of course, I think if I can see a silver lining to our workplace culture during COVID, it's just people are moving faster. And we saw definitely a productivity dividend in the first sort of 3 months, at least, of the lockdown, with people working from home and spending less time being bogged down in things and more time just being action orientated. I hope that continues. I sincerely hope that continues. I don't know if it's sustainable if we work remotely forever. But I think let's get the muscle memory. There's no reason why that efficiency can't continue. And candidly, customers aren't going to accept laggards anymore because they have alternatives. To Susan's point, they can go to monoline vertical fintechs to target a piece of their entire portfolio and, you know, work with a legacy incumbent for everything else, and they'll be happy having choice. Then the complacency becomes a challenge for banks because the fintechs can start bolting on other services to become more relevant to customers. Likewise, so can banks. So I think that's where this sort of arms race is going, I think. But candidly, it's more collaboration, it's more partnerships. No longer is it adversarial between one to the other. We all share the same customers, we all rise and fall together. And I think they appreciate seeing the collaboration because they're seeing it's positively impacted the incumbent side, and it's also positively impacted the fintech side by being more rigorous. So that's our experience, and similar to Susan's and others, I'm sure.
I think it's a great comment to hear about the acceleration of both the clock speed and the ability to move fast on the incumbent side, as well as the openness to partnerships. Jeremy, Takle, and Charlotte, representing more the startup and the fintech side, how are you viewing partnerships or competition with the larger institutions? What's working and what's changing in your minds?
If I go first, I think that, from my experience, almost in the past, in an incumbent, I know the problems that are faced by fintechs trying to collaborate with banks. Large institutions that have a heavy agenda of change going on means that actually we struggle often just to get our own strategic investments done, and the idea then of actually collaborating on new exciting technologies is almost a distraction, which is why I think, as Susan and Jeremy have made the point, is working with the venture arms of these institutions is typically a way of collaborating that is more useful. What you're seeing, I think, therefore, is that the core businesses inside incumbents aren't innovating as fast as the peripheral businesses that are inside these venture arms. And my own experience with that was prior to setting up my own bank, trying to do the same thing for a British bank, albeit in a different market in the US. But you run into those, even inside a large organization that can deploy into a space where it's allowed to innovate, you still run into those structural problems that I think are true inside most organizations. And a big part of those are silos. So in my experience, we were able to set up a digital consumer bank, build a great new platform, market directly to consumers using digital channels in the same speed and the same agility, most importantly, interdisciplinary teams working in fast decision action cycles. We were able to do that inside a sort of a ring-fenced business in the US away from the mothership. But then what we then experienced, of course, is then the silos coming in. And one example was all of our engineers who worked hand in hand with our product managers, developing and iterating like fintechs do, and the way that we would build a bank today, and suddenly removing all of those engineers and all of those technologists to centralize and reduce their cost, because they're translating their strategy into silo thinking rather than running it, rather than organizing around sort of objectives. And I think that's the biggest structural difference between the two types of firm, which is why I think to collaborate, you need to meet at the edges. It's very difficult to do it inside the core business.
Charlotte, I wanted to see your perspective on this one as well.
I think things are shifting. It's getting better. I remember my days of trying to onboard banks, and we generally go through strategic investments to see if they wanted to invest. That would drag out that process 9-12 months. And now the venture arms, to Susan and Jeremy's point, are getting so much faster at this. In the UK, we even have something called the Fintech Pledge, where the high street banks have signed up to having a point person, setting time frames in place to move this forward. But it's still too slow, and that's because there's a lot of system changes, technology changes. If you're in capital markets innovation, and potentially you're going to alter 70, 80, 100 systems for every time you put in a new piece of tech, that's not going to happen overnight. I think what we always say to the banks is a quick no is better than a slow maybe. Fintechs want to move fast, and if it's not the thing for them, they need to move forward. And I think that's what we've got to get to. But the venture arms are moving this forward now. It's less of the time it's tied to an investment, and therefore you have to then go and get the particular business arm to move this forward. And fintechs are fussy. If they don't see those opportunities there, they'll go somewhere else. So I think they in some cases have the upper hand as well.
Thanks, Charlotte. We unfortunately are at the top of the hour, and I know there's a lot more questions, and this is a topic that we could probably go on for a couple more hours, but at this point, I just want to say thanks to the 4 panelists. I think we shared some great perspectives. Hope it's been valuable to the audience. And Duncan or Tamara, I believe I will be passing this back over to you. Thanks, everybody.
Thanks.
Thanks, everyone. See ya.
Oh, sorry. I just noticed we have 30 more minutes. That was my fault.
That's why I was staying on going, I'm sure we were keeping going.
I think there's more material in the Q&A, so keep going.
Absolutely. No, I made a mistake on the timing here.
When you've run out.
Time flies when you're having fun, Steve.
Time absolutely does fly when we're having fun. Yes, let's, sorry about that, everybody. Let me,
Steve, there's a question in the Q&A about barriers to that incumbents have, and the question is whether it's about regulatory protections essentially.
Yep.
I wonder if opportunity just to answer that one of those.
Yeah. Yeah, if we could talk a little bit more about the barriers that protect the incumbents, the requirements to hold capital, dealing with the regulatory requirements. Are there things that the fintechs will avoid? Jeremy, do you want to answer?
Yeah, I wanted to have a go at that one first. Definitely, that's a constraint to some fintechs, and there's a lot of models out there that really don't require the same amount of regulatory scrutiny, simply because of the design of the model, or they've chosen a very simple e-money license structure, a simple payment structure, rather than a much more involved banking structure. What my experience, particularly in sort of, you think about core consumer banking, is until you actually start operating as a full suite bank, i.e. run a balance sheet with spread, it's very difficult to figure out how to make money in that model. And so what you've got is, as the situation that we're currently seeing, is there's a lot of early neobanks that either are sitting on top of an agency bank or really haven't started to figure out how to use their balance sheet, that are sitting with very low revenue products such as current accounts, checking accounts in the US, which are driving very little revenue, and they're not actually the main bank of their customer. So I think that as at least neobanks start to look at how they're going to monetize their models, they will increasingly look at balance sheet models, and we're seeing that with companies such as Revolut that are increasingly looking at bank license options to be able to do that. So I don't think it's an area that they're not willing to enter into. It also depends on which jurisdictions you're in. It has been a much more difficult process to receive a charter in the US, whereas in the UK, regulators had, since 2013, essentially changed the ease with which it is to go through the process, both financially, but also being guided through in pre-application to receive a banking license. And I think, is one of the good examples of regulation is really important, but actually it shouldn't in itself be a barrier to getting innovation into the sector.
Jeremy, Balkin, I know you had a couple comments on this one.
Yeah, sure. If I could maybe take a slightly nuanced view to my namesake, the other Jeremy, I think regulation gets a bad rap, an unfair rap. I think from my observation and experiences with regulators, I think they're much more commercial and enlightened than they're given credit for. I would also say that whilst the barriers to entry through regulation, which are very important to keep our customers safe in a very important, systemically important industry, at the same time, that's not an excuse for it to be complacent or indeed to hide behind that and not innovate, especially because the fintech challengers are wising up to what they need to do to meet the regulatory requirements to be credible. But secondly, because if the argument is, well, we're just going to hide behind the regulatory requirements, then what happens if the regulatory requirements change? Then what do you do? If you're not, so in other words, it's not an argument to be complacent, especially because you could just look at a lot of emerging themes that are on the record, whether it be around central bank digital currencies and that emerging in time. What's that going to mean for the role of traditional banks if central banks want to issue digital dollars, digital pounds, digital yen, whatever the case may be going forward? You think through the PPP issues of this year, with relying on banks to distribute to small businesses, and then there was a realization that not every small business uses a bank. They're underbanked, just like people are. So you could see, in some ways, taking out the middleman, which is a traditional bank for digital distribution of cash. You could think through just even the payment landscape with the sort of the globalization of data standards with ISO 20022. That's sort of going to level the playing field in sort of next couple of years across all the different traditional payment languages and data sets. And by the way, what that really is going to do and is essentially, it's going to take it less about fiat currency, or national currencies, and actually you're harmonizing the data piece. So in some ways, you're actually creating a global data currency above the traditional currency for payments. And what that's also going to mean, again, is it's going to be a convergence, and that's going to create a totally different playing field for moving money. And again, coming back to the we all like to think that banks are so complex, and maybe they are, but sort of I think it's really sort of more simple than we like to acknowledge. Is a bank's sort of fundamental role as an arbiter of trust in the economy. It's systemically important, always has been. Part of that is to be able to borrow from sovereign and then lend it out. The other core function that a bank plays is to be able to move money, so payments, and then I guess the third is sort of to manage it, whether it's wealth management or otherwise. Beyond that, every other function that a bank does is ripe for disruption whether it's the changing consumer circumstances or indeed the changing regulatory landscape that we're going to see in the years ahead. And we're not talking decades ahead; we're talking single years ahead. So coming back to core business, I think is going to be critical for both banks and fintech. Stick to what you're good at and work that muscle repeatedly. Just keep working that muscle. And I think customers at the end of the day are going to benefit the most because they're going to benefit from the competition and stronger banks and stronger incumbents, a safer industry, and probably more regulatory credible fintechs as well, which I think, again, it benefits everybody.
Hey, Steve, can I add just something to that, which is interesting? I heard on the tail end of the discussion before our panel, the speaker was talking about RegTech, right? And so as artificial intelligence and machine learning continue to actually become more refined, you're going to see more and more RegTech opportunities coming up, which actually may help some of the fintech startups be able to play more effectively, and also help enterprise, financial services institutions help, compete more effectively. I mean, there's a tremendous amount of dollars flowing into RegTech. I mean, just in 2018 alone, it was like $4.5 billion into RegTech. You're going to see more of that. And so it's good. Again, they're following the same model that fintechs and everyone else is following around simplicity, ease. I mean, if you think about the number of regulatory changes, if you want to operate in multiple countries around the world, it's hard for us to keep up with that. We actually have to leverage technology to help us do that as well. I think those tools are going to become more prolific and easier for fintechs to be able to take advantage of. And I actually think it's a good thing for everyone, because at the end of the day, it's around protecting customers and ensuring that we are doing right by them, if you will, which I don't know of anybody who doesn't want to do that.
Susan, your comment about protecting customers, I think, relates to one of the questions we're seeing come up in the forum around specifically as the industry is moving quickly and as consumers are shifting their behavior and building new habits, as Jeremy was talking about earlier. What can the industry do to help protect them from fraud? Are there any specific things that any of you have been doing over the course, particularly of the last 9 months, to help manage those risks?
I mean, look, I don't know that it changes. I mean, we've had industry-leading fraud protection rates for years, right? Driven by investments in technology and anticipations in customer behavior. So I don't know that is a different formula because of the last 9 months. I mean, e-commerce was overtaking in-person shopping a long time ago. So that's not a new thing. It's just more of it. So I don't know that there's anything that has specifically come out of the last 9 months that's driven a different equation. Certainly having fraud protections, cyber investments, cybersecurity investments are really critical for every business because there are fraudsters out there who want to take advantage of consumers. I mean, that's, again, not a new thing. I think just, doubling down on ensuring that the coverage is there. It's not a matter of if it will happen, it's a matter of when. And so financial institutions like ours have always planned for the when, not the if.
Yeah. I want to move to a slightly different question here, just to keep things moving along. In many industries, we've seen the big technology platforms, the Amazons, the Googles, the Apples of the world, move into new categories. There's been conjecture for a while that they're going to step more into banking. There's been some deals done in kind of the financial services space. A couple of, if you look at what's happened in China, the big tech platforms have actually moved significantly into banking. Any thoughts on what that's going to look like in the future. You know, whether it's through partnerships, there's a question about big tech platforms potentially buying banks to get regulatory capability. I'm curious, you know, what our panelists think about the evolution on that front.
Yeah, I mean, I certainly, Steve, if I can go, Jerry.
No, you do that one, Charlotte. I'll go after you.
It's, you know, I mean, I certainly think data is king when it comes to this, and that's, you know, we're going to see that collision course coming through with, and we've seen this. I mean, you talk about Ant and the data they hold and how they've been able to modify their products, you know, to adapt to that. So we're going to see that. We're seeing with Facebook, with WhatsApp payments in India, again, very much leading from tech into fin. Do I think that a big tech platform wants to buy a bank? No. I think, you know, would they like to have a regulatory license? Yes, in some cases, but I don't think they need to buy a bank to do that. I think there's easier ways to go through that. But certainly, when you look at the data they hold, especially around insurance products, wealth savings products, being able to adapt to smart tech in the home and what that's going to mean and how that's going to affect your financial services premiums, you know, yes, absolutely, you're going to see them come in. Why is Ford and Tesla investing into fintech? It's because they're sitting there able to take that data and then adapt to that. So partly that's going to be driven by the gig economy and how they consume and how they use data. Big tech wanting to facilitate that initially in the payment space, but you know, I think that's going to expand very aggressively. But I don't think they're going to be buying a bank.
Jeremy, you had some comments that you wanted to make on this one as well.
Thanks, Steve. And I'm actually glad Charlotte went first because in some ways you tackled the tough bit that I wasn't going to touch, but I would agree with your core sentiment about the big tech. From my observation and experience with them, they're much happier to stay big tech rather than becoming regulated like a financial institution. With that being said, I think I sort of alluded to this in my earlier remarks, which is, you know, you think the threat to incumbency with big technology companies. Apple's a good example with what they've done with Apple Pay. You look at Alipay, another good example, creating these closed-end digital payment capabilities, you know, on a mobile device, which is just creating their own incumbency. And it's very difficult for traditional payment processors or banks or merchant banks or issuing banks to get in on because it's their own. They own the whole closed-end system. And so again, as particularly young consumers, I talked about sort of C2B2B. So as younger consumers who are becoming, you know, who not even becoming, they are literally everything on a phone, including payments. You know, the ecosystem's only going to get bigger and bigger. Not likely to be these issuers, etc., payment processors, and I will that, you know, so the banks, that'll be an interesting way to navigate that too. I think also it'll be fascinating. I think there's a lot of talk about traditional financial institutions wanting to partner with big tech, and I think, you know, there's been some good examples and some not so good examples. I think that what we'll probably find, if I had to make a sort of a decade-like prediction, it'll probably reverse, because the big tech companies, if these sort of two examples I just mentioned earlier and others become much more robust, they may well want to look at sort of banking as a service, so almost as a bolt-on to what they've built within their ecosystems, all the data they hold, maybe touching certain parts of the financial services ecosystem like payments, but there may be legitimate reason to want to sort of rent a bank, and a credible bank, not a sort of fly-by-night bank, because they want to have the name to give their their data and digital products financial credibility to do more. And I could see that becoming much more of a convergence and more likely to happen, not necessarily tomorrow, not necessarily next year, but I think if we're doing this in 5 to 10 years time, I think it's more likely than not.
Thanks, Jeremy. There was a question in the panel about are there any significant changes in the strategy of UK-based fintechs as they digest Brexit and how they're thinking about markets outside of the UK? Charlotte, I think you wanted to provide some comments on that one.
Yeah, well, it's a pretty live conversation, as you can imagine. When we ran a census with Treasury and EY ran it in 2017, you know, the top market for UK fintechs to expand to was Europe, obviously, and then followed by the US. Now, what you're seeing is those fintechs still want to access Europe. They're going to probably end up with a second license. So I don't think we're going to get equivalence or mutual recognition at this late stage. And they've been going through that process for some time. In fact, some of it went through 2017, got it ready, and then have mothballed it. So they still have access to Europe. It's just adding cost and complexity, and there's more complexity around the data sharing over everything. And some markets are taking advantage of that. So do you want to go through it quickly? And which markets is the easiest and quickest route to getting that license, depending what you want to do there. But certainly, as I understand it, there are markets that have a significant queue of license applications coming in from UK fintechs who are quickly getting ready for next year. However, when we take the new wave of UK fintechs, maybe what we're going to see is they may think I'll prioritize the US. It's a bigger market. Maybe that's easier for me. Not the easiest regulatory environment either, though, to attack. But I think it does potentially change the strategy going forward. But at the moment, it is the easiest market to get to. Obviously, same time zone, etc. And I think we will see them leveraging that second license. I have been concerned about overseas fintechs who want to come to Europe, land in the UK, and then have that automatic access to Europe. And we were really concerned about that a couple of years ago. I think now we still see the UK is a huge pool for financial services, obviously, and while financial services is still so strong here, I think there will be fintechs will come through London regardless, and the rest of the UK before they go elsewhere.
And Steve, just one more thing on that, perhaps, is inside core banking and consumer banking particularly, I think in a way we've operated with separation of a lot of the European markets and into US for a while. And it's really been driven out of the sort of post-2008 ring fencing rules, which means that every market essentially has some level of local regulation. Indeed, consumer banking is typically a multi-domestic business, not really an international business. And so if you're operating in Germany, BaFin are interested in what you're doing and would like to regulate you. And because of, as I said, ring fencing rules in the UK, you reach a certain size inside banking, you really are looking at separate regulation and surround, and that's been done not because of Brexit, but because of legitimate structural questions that were trying to be addressed beforehand. I think that means that at least for the more heavily regulated elements of fintech, it's no change to what we were already experiencing.
Jeremy, we had a question in the panel come up about a large market opportunity with digital illiterates and the underbanked. The question talked somewhat about regulation, but I want to make this more broad and ask our panelists, do you see a significant opportunity to serve digital illiterates and underbanked today? And what are some of the key trends you see, whether driven by regulation or not, to address needs of that part of the market?
Steve, may I have a go at that?
Absolutely.
So two projects that I've personally sort of co-led and been really proud of, specifically around this piece, one being a traditional fintech partnership, digital distribution at scale around financial literacy and financial education and financial wellness, and one being a physical piece of technology with a big tech partner, which I'll talk about both because they're addressing the same issue from two different angles, one being the physical angle, one being the digital angle. So specifically, as an Australian, as an expat, as an immigrant to this great nation, I've been here for 7 years. I always thought when I came to America that Americans spoke the same English that I did. And I found it particularly difficult to communicate early on here. My accent was very strong. I had to repeat myself multiple times. I frankly felt like, pretty silly, to say the least. And so that gave me quite a good empathy for folks that don't speak English as a first language, for example, trying to navigate this great, huge melting pot, multicultural economy. And so, there are 70 million Americans where English is their second language. So if you think through just the barriers to entry to be a non-English speaker in this economy, but we also know how complex financial services, particularly consumer finance, tends to be. So the barriers to entry for financial literacy, financial wellness, making the right financial decisions, especially for younger people, are much, much higher. And of course, Hsbc being the sort of the leading international bank, 30% of our customers in the US are internationals, it's sort of this convergence. So, we did a partnership with Google and a fintech company called Valara. We launched it in January of this year at this Consumer Electronics Show in Las Vegas, which, by the way, feels like 25 years ago because it's been such a long year. Around harnessing real-time artificial intelligence capabilities to translate 95% of the world's most spoken languages through this Google device with this sort of, think of it as almost like enterprise level Google Translate that was built by this fintech Valara. We partnered together, we did a POC in a couple of our branches in Manhattan to deliver in an in-branch experience where customers, if English wasn't their first language, they could communicate through this device with our wonderful universal bankers and solve that problem. That's a tangible physical example. Let me talk about the digital one. We partnered with a company called Everfi, probably the leading education fintech in the world, or certainly in the country, based out of DC. We built something called the Hsbc Financial Wellness Center. And sorry for those on the other side of the pond, center is spelt the American way, not the British or Australian way. But hey, we couldn't win every battle. But we built the Hsbc Financial Wellness Center as a sort of a digital module with sort of a web interface, mobile interface to deliver modules and content to customers, potential customers, staff, employees, employees of other customers. So if you think through, we do financial wellness seminars at some of our major corporate banking partners, because if you think of population flows and temporary workers moving across borders, we have a great business there for employee relocation, and we do these seminars on financial wellness. It started off being in English, then we did a Spanish language version. I think we're doing a Mandarin version that if it hasn't already been launched, is being launched. We've seen in the first month of the pandemic, for example, we saw a 3x increase just in traffic to the site, like in March of 2020. So you can imagine, that what started out as what we thought was the right thing to do, whether you want to call it a pro bono community engagement type opportunity, actually has been enormously commercially valuable. And I think it just goes to show you can do well by doing good. Sorry to sort of go off on a different tangent, but if you do the right thing, actually there's business dividends there too. And the Financial Wellness Center has actually become a product or a service that actually is one of the best entry points to doing business for our other products we've seen in the marketplace here. And we're really proud of that. And it just goes to show that when you use the digital capabilities that can drive scale, that can drive lower cost to serve, that can get into more people's eyeballs through their phone or digital devices, you can do immensely scalable, positive work that's actually good for business and good for the community too.
Steve, it's a really interesting question, right? And I think I would actually separate what I would call digital illiterates from financially excluded, right? Because they're not the same thing. And I think they're two different solutions for those. And I specifically focus on the financially excluded, which, Jeremy just talked a lot about what HSBC is doing. And I would just say that, at the end of the day, it's actually an imperative if we want communities to thrive, to be involved in this discussion, right? Not just from a business perspective, but from each of us personally getting connected to what the issues are associated with that, because it has future implications on everything, GDP growth, you name it, for a community. If you have whole groups of people that are excluded from participating in helping build wealth for themselves. And so there's a couple of, several startups that have focused in this area. A good friend of mine, Wole Coxum, started a company called Mokafi. And so he has actually been literally trying to focus on this whole thing around financial literacy and connection for communities that have not had access before. I know PayPal has been thinking about other things. And just in the last 6 months, you've seen several companies, including ours, really step out there and say, look, we're making really big commitments to communities that have been traditionally underserved to help move this entire conversation forward. This can't be a flash in the pan or just a one-time thing. Like, look, as an African-American woman who works very closely with young kids who look just like me, I was just actually on the phone before we started this panel talking to some folks because New York City is about to shut down schools tomorrow or today rather. And there are all these young kids who fall into this category who don't have access to iPads for school, don't have access to internet. All of these things are interrelated. And so the financial services community cannot be disconnected from these issues. They will have long-term implications for the challenges that we'll face in the future if we don't address it now.
Thanks, Susan. Charlotte, I think you had some comments you wanted to make on this one as well.
Yeah, so I've always said that the purpose, the purpose of fintech is democratization of financial services. It's adding more transparency, more ease. And it's there to help people who don't have access to those financial products or services, or people to understand what they do. And it's really important that we keep that focus. This isn't just to make more efficient financial services firms get higher margins. And I get most excited when I see fintechs who are looking at this space, addressing it in so many different ways, whether it's through literacy, wellness, but even in savings, helping people save and working out where their savings are going. We've seen some really great partnerships between banks and fintechs on green, and showing that actually their money is going to ESG or green. So I think incredibly exciting opportunity. Most young kids do have access to phones. They don't. I'm with you, Susan. They don't have access to iPads, and online learning's been just awful. But how can we harness that interest in technology to drive through financial wellness? So we, just this week actually, we've just launched something called Fintech for Schools, where it's a mobile web app doing exactly that, and it's trying to put it into young people's language, whatever background they come from, whichever school they go to, because 70% of kids get their financial literacy learning through their parents. And that's great if the parents are able to produce that, but it's not great if they can't. So we have to collectively use the power of technology. We need to find ways of cooperating between banks and fintechs and government and regulators to drive this through. So this, this drive for digital and the impact of COVID doesn't exacerbate this problem, that it actually helps to resolve it.
Thanks. Quick question that came from the panel. Anybody's perspective on the pulled IPO of Ant Financial? Is this helpful for Western institutions and fintechs, or do you not see it as having much impact?
I mean, I'll come in with a really interesting stat quickly, that there wasn't a VC investment into China fintech in Q3. So while we might be focusing on Ant because that makes the big headlines, when you look at others, that there's not the pipeline there. So it's going to be really interesting to see what happens. But maybe we'll have to talk to Mr. Ma and get him to this somewhere else.
Yeah.
Yeah. The other way. Sorry, Steve. The other way, just looking at that problem. I mean, one of it is a financing issue that's obviously facing Ant. But I think we as we mentioned before, there is this distinction between the models that we're seeing coming out of Asia and China, particularly when you go there. The super app model is one that actually I think is quite unique to those fast-growing emerging markets, now quite well developed, because their underlying sectors in banking and elsewhere aren't really performing those same roles. And so this idea that you're then exploiting the fact that you can quickly build alternative models and use that data, I think is quite specific to those markets. I think the opposite is what we're seeing in Europe and the US, particularly back to my opening idea around open finance, because I think the alternative to the super app is the one that I think we're increasingly seeing, where customers themselves can curate their own finances by having essentially apps from different providers and curate them and pull them together using open finance. Interestingly, that's progressing very quickly in the UK and Europe because of PSD2 and open banking. But actually in the US, it's perhaps more advanced on a sort of more of a open model that was generated by the fact that you had the mints and the movens, et cetera. That means that people are much more willing to aggregate and use traditional screen scraping even to aggregate their accounts. And that means I think you're seeing a very different pattern of how fintech is being deployed into users' hands in the sort of, if you will, the UK-US model than you would see coming out of with the super apps from the Asian model.
Thanks, Jeremy. With that, I do believe we're coming to a close. I wanted to thank Charlotte, Susan, Jeremy for taking questions and providing us with a rich conversation this morning. I see Mark Tucker is coming into the screen in a minute here, so let me pass it over to you, Duncan, to take us to the next speaker.